Yeah, she can walk around. Ready? Good afternoon, everybody. Good afternoon. Let's get everybody in. Grab a seat. How are you doing? Good to see you, Lee. Grab a seat. Hey, drinks around the corner. All right. So I think we've got just about everybody in here. Good afternoon, and thank all of y'all for coming out. Very much appreciated. Yes, I'm a new face to Brad's clients, very much so, but y'all are new faces to my clients as well. So it squares up that way. It works out. In August, Brad and I have known each other for 40 years. We were roommates back before we were married. So we go back a long, long way. Don't ask for any stories because we've guaranteed to take those to the grave. But we are excited to be here. Back in August, Brad had left the Major Wire House about four and a half years ago now. And we left in August. And so in conversations with Brad, being business owners now, our own business, Brad had space in his office and he said, why don't y'all just move in with us until you decide what you want to do or where you're going to go or where you're going to be. So we did. We moved in there, and our two teams have known each other for a long, long time, going back to Merrill Lynch days. So it's like it just kind of has melded together very nicely. And his team has been a huge help in our move over. So thank you to April and Cheryl and Grant and Lori. Thank you very much. And also to my team, I want them to just kind of stand up real quick so you can see who. Miss Erin, are you here? There's Erin. I got Bobby over here and then Linda right there. So those are the new faces you see around the office if you stop in. That's what we have done is moved into there for the time being until we decide what else we're going to do when we grow up. But we are really, really excited to have Marianne Bartels and a couple other guest speakers here with us. Marianne, you've probably seen if you watch CNBC. She's been a regular on there for many years and is really, really very good at what she does. She cleaned up in 2024 on many different awards, and we're expecting her when it comes down at the end of the day in 2025 to also have won many of those same awards. But I also want to thank real quick before we get going, I want to thank April and I want to thank Cheryl and I want to thank Grant and my team for all the work that goes into putting this together. And it is a lot of work to get y'all here, get the invitations out, get everything ordered, get people in the right places. So thank y'all very much for all of that. And, but we are looking forward to this. It's going to be a great afternoon. I'm going to learn a lot. And with that, I'll turn it over to Brad.
Thanks, Larry. So tonight we have, as you can see, the cameras and the TV and the AV, we have Joanna and Lindsay in our Arkansas shop. They're sitting there tonight with about 25 of their clients and they're watching this. So we'll give them a warm Fort Worth welcome. We also have Marianne and Rachel, not this Marianne, the Marianne Rachel from Chadwick, North Carolina with us tonight. And a lot of their clients are online with us tonight virtually. Then, yeah. And then lastly, we have about 27 companies that we have been entrusted to do retirement plans and to build retirement futures for about 4,000 lives. And those people have been invited and they're all over the country. So we want to welcome all of them tonight as well. So this is our fourth year of our year ahead with Marianne. We've been doing them over the years, but once we started with Marianne, we just couldn't stop. And thankfully, she comes down every year and, usually goes to the rodeo, but a little early this year. That's my fault. It is. We're excited. We're excited because Mary Ann is very important to us and how we go about making decisions in your portfolio. She has been someone I've leaned on for the last 25 years prior to coming here, as well as back at the Merrill days. And so tonight we're going to do something a little bit different. Mary Ann's going to come in and talk to us about her outlook and the year ahead vision. But we're also we got Phil Huber, and we also have Cliff Water and Franklin Templeton here with us tonight, who's going to give a little different perspective. So, Mary Ann, why don't you start us off with yours, and then we'll work to the next.
Oh, I don't need that. I got a special one. Good evening, everyone. It's kind of evening. Thank you so much for having me again. It's the only time I can wear this outfit because when I walk around like this in New York, they look at me funny. I look okay, right? Yeah, I got it down, right? Thank you. So I write my year ahead right before Thanksgiving. And, I sit there and I do labor over this. This year it was a little rough, trying to figure out what was going to happen. And when I was looking through all the material, I said, I don't think 2026 is going to be an easy year. Have you read the news, heard the news? But the title I came up with, because I thought it was going to be a challenging year. By the way, I did not realize the kind of challenges we were going to have. I titled my report, Be Fearless, and I still have the bull, and I still have the bull running. That I said, no matter what happens, I think we're still going to wind up being okay. And I want clients to be fearful. I want them to stay invested. I don't want them to panic. And that cannot be more true given the first 2 weeks of the year, where I'm even having a hard time keeping up with the news and what's happening. But one of the things I was most excited about when I actually wrote this is the other little part that's down there in the white letters is a global equity, well, it should say equity, but it was too long, a global equity secular bull market. That as I was taking a trip around the world trying to figure out what was happening, the one thing I realized is there was something happening outside of the United States that was magical. Something I never saw in the 40 years that I've been doing this job of Wall Street. And normally when we invest outside of the United States as Americans, we do it for a couple of years and that's it. Because it's really paid to be invested in the United States. We haven't needed to have international exposure. But I think we're in a very pivotal point where something magical is happening outside of the United States, and that it's going to pay for US investors to actually have exposure outside of the United States. So if that's the big takeaway, is when you're going to have volatility in a market, you really need diversification, because diversification helps as things are moving around. And I think this is the first time in my 40 years that I'm saying to diversify outside of the United States in a significant way, not just 1 or 2 years. So if you need to leave, that's the summary. So let's look at the US economy. There's a model that comes from Atlanta, the Atlanta Federal Reserve. It's called the GDP Now Tracker. Doesn't work 100%, doesn't get it exactly right, but it gets the trend right. And right now, that model is saying the US economy is growing at 5%. Now think about that. Do I have business people in here? I have no business people? How could that possibly be? Do I have retired business people in this room? There we go. I got retired business people. 5% is a big number for the United States economy. That's an emerging market. You'll hear China growing at 5%, although that's low for them. If we really are growing at 5%, that's quite significant. But why is that important? Come on, business owners. If the economy's growing, what happens to your earnings? What happens to your revenue? They go up. Yes. And if the economy's doing well and you have earnings, what else goes up? Stock market. And that's the link to markets. You have to have earnings. And if you have those earnings in time, that will be reflective in stock prices. But there can be things over time that disrupt that. And we're probably in a year where we're probably in a year of disruption and volatility. But if companies are able to produce those earnings over time, the market is going to go up and stay up. Now, it's the midterm election year. You probably already know that. During the midterm election year, markets are extremely volatile. And markets on average are up 3%, but there have been times we've had bear markets. That means stocks down 20%. But on average, we're kind of up. But if you notice, based on this chart, the monthly, there's a lot of downs. And that's one of the things that I was thinking of when I was doing my year ahead. I'm like, it's the midterm elections, it's Trump. You know, we're probably going to have some volatility. Plus, we've had the markets up 3 years in a row. And we've had strong double-digit gains. Maybe we get what's called a reset, right? Just resetting prices so we can go higher. So I want clients to be fearless in their investments, knowing that over time, all these things that are just even happening in the first couple of weeks should be able to work out in a positive way for markets. What's been leading the markets, I'm sure you've heard by now, is AI and growth stocks. So technology companies are growth stocks. That means they have higher earnings, higher valuation. And you see this little line, this line here, down here, the smile. You see the smile down there? Smile. So I was trained by my aunt. She went to Wall Street in 1956. Could you imagine as a woman going to Wall Street in 1956? So you're asking, why did Aunt Bernadette go to Wall Street in 1956 when there's no women there? Because her uncle got her a job out of college. She rejected the job 3 times, but they kept calling, so she was very religious. She said, well, I guess God wants me to go do this, so I'm going to go work for this firm. She wound up on the trading floor, which is the worst spot for a female to go. It's very intense and very language intense. Her boss actually apologized to her. Her first day, he said, I'm going to apologize. I'm going to apologize one time for what you're about to hear out there, but I'm not going to stop them from talking. Anyway, she wound up having a whole career on Wall Street, wound up with her own company. She started training me when I was a teenager. And she told me she taught me really pattern recognition. There's certain patterns repeat, and they're bullish or bearish. And she told me when I see a smile, it's very bullish. Right? Happy, smile, bullish. If it's a frown, not good. The more years that are there, the higher you go. And this starts all the way back in 2002. Ooh, I'm too close to that thing. And this is 2020. That's a big time period to be in a trading range. And if you notice, then it kind of went up, went down, went up. And we're kind of coming down again. And that's part of the reset. I think technology growth stocks are under a reset, but I think they're going to go back up again. Why? Because that's where the earnings are. And the earnings power is there. But things don't go up in a straight line and stay up. What you learn is over time, they need a reset or to correct. The question is the cycle ending? And I don't believe the cycle is ending. The cycle is still early in its stage, not early in terms of performance, but in terms of AI, it's still very early. I do believe we're going into a bubble. All they talked about last year is AI in a bubble. If you turned on TV, every question was AI in a bubble? Is AI in a bubble? AI is not in a bubble, but I've been predicting a bubble. Now, a bubble compared to what? 2000 and to 1920s. Okay, so if you look at the purple line, that is the NASDAQ 100 today. That's where all these growth companies are. If you look at the green line, that's the .com. That's the 2000 period, the late 90s, 2000. And if you look at the blue line, that's the roaring 20s, the 1920s. And it's staggering the parallel of the performance of our market today to those 2 periods. I think eventually we will go in a bubble. And I think that will happen towards the end of the decade. And I think by then the S&P is going to be at 10,000 to 13,000. Yes, wow. Somebody said, wow. So you want to stay invested. Then you're all sitting there going, well, what happens when the bubble bursts? Well, there's other opportunities that come up. I'm not necessarily a big fan of Jim Cramer, but he does say, his personality-wise, and he's interviewed me and he was not nice to me. So Anyway, but he does say something that is absolutely true. There is a bull market everywhere. You just have to find it. So just because a secular bull market ends, what happens is a new secular bull market is beginning somewhere else. And where that new secular bull market is right now is in the international stock market, in my opinion. Now, have you ever heard of Sir John Templeton? And we have Franklin Templeton here. He's my hero. I managed a global portfolio back in the 1990s, and he was my mentor. Not personally, I just read a lot of his books and listened to the man. And there's one thing he said that is absolutely correct. We're in a secular bull market in the United States that started in 2013. So what does secular mean when I use these terms secular? It means a very long time. 15 to 20 years is a long time. And when you're in a secular bull market, you will have bear market returns. You'll go down 20 or 30%, but it means you go back up and go to all-time new highs. The whole cycle of the secular bear market, Sir John Templeton labeled in terms of how we feel about markets. So secular bull markets and even bear markets start on pessimism. Nobody sees them. Everybody's bearish. But the markets keep going up. And so now you start getting skeptics. They're like, well, yeah, maybe. They're still not quite on board yet. Then they start waking up, well, maybe something is changing. There is something positive. That's so we become optimistic. But markets don't peak until you have euphoria, until everybody's in and nobody sees that a market is going to burst. I think today we flip-flop between skepticism and optimism, right? There are days that we're very skeptic. Probably right now we're moving a little bit more towards the skeptic side. And when things are going really well, we go optimistic, but we're still a very, very long way before we're going to get to euphoria, giving me confidence that the S&P is tracking towards 10,000 or 13,000. Now, this makes me very excited. This is the MSCI EAFE index, probably something you've never heard of, but every international portfolio manager or global portfolio manager knows this index. A lot of international money is managed to this index, and it stands for, right, it's EAFE, Europe, Asia, and Far East. There's a lot in here. And if you noticed, in 2007, they had a peak just like we did. They crashed and burned just like we did. But we broke out to all-time new highs in 2013. They did not. They just broke out. Does anybody know how much the S&P is up since we broke out in 2013? Anybody do quick math in their head? You can do it on a calculator really quick if you know the averages. We're up 340% since 2013. That's spectacular, right? They just broke out. Their breakout to me is just what we did in 2013. This is new long-term leadership within the marketplace. One of my favorite markets has been Japan. Japan was in a secular bear market for 35 years. Could you imagine being an investor with zero interest rates? I don't know what retirees did. But Japan finally broke out and reached record all-time highs, telling me they're in a new secular bull market. Why are they in a new secular bull market? Because they have growth policies, economic policies. And I know this is going to sound hard to imagine, but there was a time where Japan did not manage their corporation for earnings. They now manage them for earnings. They now have corporate governance. They're buying back shares. I don't know if you follow the stock market. Every time a company buys back shares, somehow their stock price goes up. Japan is buying back more shares than we are today in the United States. They're also strategically positioned in Asia. What's happening in Asia is a big trading block. They're trading among themselves. That's helping their growth. In addition to that, Japan is very good with technology, and we're in an innovative period, right? We're into the digitalization. So I think Japan is going to continue to do dramatically well and be a major exporting country. You hear about Vietnam, right? Since we have all these new tariffs and blocks and countries or companies now trying to find other places outside of China, Vietnam has been a major beneficiary, but something else has happened with Vietnam. Vietnam was not considered part of the emerging markets. So if you looked at an index of emerging markets, Vietnam was not part of that. They are now part of it. They were just up, it's called an upgrade. They got an upgrade, and they are now part of that. And they've had amazing performance, and I think they'll continue to have amazing performance. Because not only, when I look around the world, I see Europe in a secular bull market, I see Japan in a bull market, and I see emerging markets ex-China in a secular bull market. I have never said that in my entire career. Something around the world is dramatically changing. Now, have you heard the US dollar is going to zero? Have you heard that? The US dollar is going to fall apart. It's not going to be, you haven't heard that? Oh, you're not paying attention to the news. Because every time I turn on the news, somebody's trashing the dollar. Dollar's going to go down. The dollar's going to go down. It's not going to be a reserve currency anymore. I think it's bullpucky. I think the only thing that they're talking about is this pattern right here. Yes, are we down? Yeah, we're down. But oh, we bottomed in 2008 and 2009. And if you really look, the dollar's actually been a very strong currency. It's not a weak currency. They're only telling you the short period. And you see this trend line that it hit? If you don't want me walking around, just tell me. Tell them I'm too busy, please. Can't take their call right now. See this trend line? And that's holding the trend line. I think the dollar is going to be a strong currency. I think it'll at least stable. So all these people that are saying the dollar is going to collapse, it's going to go down, you know, nobody wants dollars anymore. I think that's bullpucky. I don't see it happening. Now, rates have been coming down. That's one of the reasons why we've had a weaker currency, right? When you do interest rate differentials and you look at interest rates around the world, it's one of the reasons why the dollar's been weak. This is the 2-year Treasury yield. It's the front end of the curve. And the Fed has been cutting rates aggressively. Now, what's different this time? And this is different. They say it's never different. This time it is different. We have never seen a Fed aggressively cut interest rates while the economy was growing and corporate profits were growing. It adds stimulus. And this is the first time the Fed went to 0 to 5%, aggressively raised rates, and we didn't go into a recession. So part of the economy has changed in terms of how we're seeing interest rates move. But if interest rates are low, and if they're able to take interest rates lower, that's going to add fuel to our economy. And what I've been saying, and other people have been saying, is AI, artificial intelligence, is going to help us drive productivity growth. And we just got third quarter productivity growth, which came in almost at 5%, which is extraordinarily high. And if we can maintain that, that is very good for us, because unit labor costs are coming down and you're getting more per worker. That's the productivity. And maybe that tempers part of inflation. I don't think it's going to temper all of inflation, but can temper part of inflation. And even when I look at the 10-year Treasury, it's been in a downtrend. But if our economy keeps growing, the risk is that rates go back up again. Not necessarily sustainably higher. Could we go up 4.5, maybe 5? Yes, but it'll be in the context of a downtrend. What's happening is our yield curve is steepening, where longer rates are higher than 2-year. That means you have a strong economy and you want a strong economy. So everything that I'm looking at is extremely bullish for corporate America. Now, is everything in harmony? Everything is not in harmony. Have you noticed that there's actually inflation? Have you gone shopping, food shopping? Now, they tell you inflation CPI, right? Our CPI numbers came in. They're down around 2.7. We're seeing inflation come down. Has your grocery bill come down? Yeah, that's the problem, because inflation is based on rate of change. When I look at ISM, manufacturing and services, these are economic indicators. One of the things, here's CPI, it's down here. We do have low CPI. But when I look at ISM manufacturing, which is blue, and I look at ISM services, which is the purple one, the blue and purple, manufacturing is blue and this purple one, prices are up. And another thing that I pointed out, but I don't have a chart, is raw industrial material prices are breaking out and going up. That means input costs. PPI numbers came out today and they were higher than expected. And if raw industrial prices are going up, the risk is PPI will continue to go up. And I was trying to remember if I ever could recall CPI down and PPI up. I can't, but that's a lot of history that I may not know. But it may be possible that we have pockets that have inflation and pockets where we don't have inflation. And that's also something different, but it's something that can spook the bond occasionally. Now, I keep talking about corporate earnings because they really are the most important things. You see this beautiful red line? The beautiful red line, I'm giving you too much attention. I have to go over here, but I can't get too close. It's going to go, see that red line going up? That's earnings. And that's why the stock market is going up, because we had extraordinarily strong growth to earnings. Now, look at that red line and blue line. In 2025, analysts didn't see the growth in earnings. They missed earnings, which means we had big surprises in earnings, and that helped stock prices go up. I think we finally reached a point where the analysts have caught up to where the earnings are. And then all of a sudden, the company reports the number, but it doesn't beat. Wall Street likes beats. So the risk is that we're disappointed. Look at the banks today. They reported extraordinary earnings, big banks, and the stocks were down. Why were the stocks down? Because they reported extraordinary earnings that the market expected. They didn't exceed expectations in a big way, because there's something that's also called the whisper number. And if you don't beat the whisper number, anyway, so I think we can get volatility in earnings. So the earnings will be good, but there's chances that markets are disappointed. Now, why are tech stocks going up? Because that's where the earnings are and the bulk of the earnings, but they also have a very good return on equity. And we don't talk about ROE. That's ROE's return on equity. The market's returning about 20%. Tech companies are returning 30%. And if you really look at where we're going with innovation, think about all the semiconductor chips we still need, right? If you really want to build out artificial intelligence and data centers, you're going to need these specialized chips that NVIDIA has. But in your car, does your car beep at you? Yeah, do you know you need a chip for that? Driverless cars need even more chips, right? Your phones, your iPads. Anybody have a smart home? Can you connect to your ovens, your dishwashers, your refrigerator? Well, how do you do that? You need a chip. If your satellites need chips, drones need chips, robots. Did you hear we're going to eventually all have a robot in our home? Musk is going for it. That needs a lot of chips. So we're still in the very early phases for the demand for semiconductor chips, and they've been the leaders of the market. Once we get close to saturation of building what we need to build, then we might have a problem in the market. But I still think tech and innovation, and by the way, the leadership of technologies in the United States. There's no other country that has the amount of technology and innovation and venture capital to support that than the United States. But the value proposition, meaning cheaper, less expensive, is in the international markets. The other thing that's helping the economy is you've got money. Your house is going up, right? Your portfolio's going up. And when your assets go up, don't you call your financial advisor and say, how much money can I spend? Does Larry and Bruce get a telephone call? How much money can I spend this year? That's also bullish. But what we're seeing is have you heard this term called the K economy? You haven't heard the K economy? Well, I'm going to educate you on the K economy in case you hear the K economy. They're saying the high-end consumer spending, right? And the low end is the lower part of the K. But it's really not a good analogy because that lower end is not spending because it looks like they're not spending. They actually are spending. All consumers are spending. By the way, you can follow this. Go up to Bank of America's website. Go to the Bank of America Institute, and you can get all their research for free. That is, if you have an account at Bank of America, they're tracking you. And they consolidate all this data. And essentially what's happening is the high-end consumer is spending at double the rate of the low-end consumer. If you listen to Delta Airlines CEO, he'll tell you that comfort and first class is doing a lot better. They're catering to the high end. That's where they're making their money. So the high end is doing very well. So some people think this low end is not spending. They actually are spending, just not at the same rate. So as long as you keep spending money, because you're 70% of the economy is also fine. Have you heard about gold and silver lately? I like it. I think I have some on. So gold is going up for every reason possible. It's going up because there has been inflation. It's going up because of all the geopolitical risk that is out there. It's going up because central banks are buying. It really has been an old-fashioned way of putting a hedge in a portfolio, a diversifier. And we have not needed gold in a portfolio in a really long time. I think you can add gold to a portfolio now. Silver is not necessarily considered a portfolio asset like gold. However, I think you can treat it that way. In fact, it's called, at least when I was growing up, it was called poor man's gold because it was cheaper to buy. Silver is actually broken out. There's something happening. Platinum is broken out. There's something happening with metals, not just precious metals. All our industrial metals are breaking out. So another way you can hedge is by owning the companies that have exposure to all these metals. And they just recently broke out. And I think they just started a new secular bull market. And I think those are good diversifiers in a portfolio because I think maybe in the next 5 to 10 years, 15 years, inflation is going to be a lot higher than where we are today. You know, all this money that's been spent by the government, by the Fed, low interest rates in a time that an economy is growing, I think over time will risk inflation. And I think having equities is a hedge to inflation, but having metals is also a way of diversifying that. Have you heard about this thing called Bitcoin? Some people, my dad would have called it air pudding and wind sauce. And think about air pudding and wind sauce. What the hell is air pudding and wind sauce? It really is nothing. But when we were kids and he had to feed us, there were 3 of us. My dad couldn't cook. He opened up a can of Bean and Franks. And of course, none of us wanted to eat a can of Bean and Franks. But then this magical story about him meeting Gilligan and the skipper. And so I literally grew up on a small island that was only 1.5 miles long. And there was another island behind that my dad worked on that was half the size of that. And how they would go to this other island, which happened to be called Hart Island, and how they would go there and how my dad would feed them. And he also fed them air pudding and wind sauce for dessert. And we just kept eating. It feels like there's nothing there, right? You can't take Bitcoin out, right? It's like Wi-Fi. So, and it's not backed by a country. There's no backing, but it's here. And the government has said, based on legislation, that, you know, because we have ETFs, we have futures, that this is a real asset class now. This is considered an asset class. Now, I'll just bucket baby boomers. Baby boomers don't understand this. But if you talk to any younger person, at least half your age, they're all over this. Why? Because they grew up with everything being out there in computer, in space, on the phone. They're fine not having tangible. You talk to any young kid and ask them for $1, $5, there's no money in their wallet. They don't even have a wallet. We're in a stage where it's a major transition of moving from paper money to digital money. Now, will Bitcoin be here in 100 years? I have no idea. Nobody knows if it'll be here in 100 years, but for now it's here. It is being used as an asset in portfolios. It is extremely volatile, the most volatile asset class I've ever seen. But when we put it in asset allocation models and we add 1 or 2% to this asset class, you actually have better performance and lower volatility. So I'm just putting it out there. I think it's important for you to maybe understand a little bit of it, just to have conversation with some of your younger family members. And if you're managing your wealth for wealth transfer, is that something that you want in a portfolio for wealth transfer? Is that an asset class that will be there that they might need, right? I don't know the full answer. What I will tell you is it for my younger cousins, my 10-year-old cousins that I'm very close with, and even my children, guess what they got for Christmas? They got Bitcoin. And it went in their portfolio. I bought them $200 each of Bitcoin. I'm like, if it goes to zero, so what? But it's in there, it's topical. But when I went to the 10-year-olds and told them their Christmas gift was Bitcoin, they were so excited. 10-year-olds were excited that they were now Bitcoin owners. So I'm just saying. You know, these are all the risks. Bottom down here was geopolitical risk. I figured with Trump, I had to add geopolitical risk, had no idea. I'm still concerned about inflation. I still think it can peak up from time to time. We've stopped talking about deficits. Actually, the deficit is improving, and particularly the trade deficit because of the tariffs, and no one's talking about it. But if the bond market wants to have a little bit of a hiccup because we still have deficits, that's always a risk. And as I said, I still think earnings may have a hard time beating expectations this year. So that's our outlook. I do want you to be fearless. I want you to stay with the bull. And come on, it's Texas, right? You are the bull. And I want to invite up our guests that are going to talk about their views on the public markets and private markets. I got Phil and I got Tom. Can Tom sit here? Yeah. You sit there. I'm going to start with Tom. But what I first want you both to do is can you each introduce yourselves and talk a little bit about the company that you work for? In other words, this is your sales pitch.
Sure. Can you hear me? Can you hear me okay? All right. I'm Tom Nelson. I work for Franklin Templeton Investments. I'm a portfolio manager with our multi-asset team. So we're the group of folks that builds and manages portfolios across stocks and across bonds and across commodities, and includes a little bit of Bitcoin. And so we're asset allocators. We're more macro investors, if you will. I've been with the firm for closing in on 20 years now. I've been in this crazy industry since the early 1990s. And I also serve as the head of market strategy. So I spend most of my time thinking about portfolios and thinking about markets and boring the heck out of my wife and kids when talking about things.
And Tom also sits on our investment committee at Sanctuary Wealth. So you're part of our investment committee.
Correct. Yeah.
Thank you. Hello, everybody. My name is Phil Huber. I'm the head of portfolio solutions with Cliffwater. We are a private market and alternative investment specialist and fund manager. We've been in business for about 21 years now. We were founded initially to serve large institutional pools of capital, such as pensions, endowments, foundations, advising them across their alternative investment portfolios, helping with everything from asset manager selection and due diligence, portfolio construction, et cetera. And then fast forward about 15 years after our inception, we began introducing funds to advisors to use for their clients across areas like private credit and private equity. In my role, I help publish a lot of our research that we put out for advisors, advise on overall product strategy and positioning for our fund lineup, and help support different advisory firms across the country in the work that they do with you all as it relates to our solutions.
Okay, so we're going to start with Tom. So at Franklin, your year ahead outlook, why don't you just give us kind of a summary of where you thought we would be heading in 2026 in terms of the economy, inflation?
Yeah. And so, yeah, to your point, I think when we talk about our views on the markets, time horizon matters a lot in terms of how you think about things and what you think about things. So generally, with the time horizon that we're talking about, it's kind of a 6 to 12 month outlook. I write a piece twice a week early 2026 has been incredible with just the amount of data and information and news. Bob Weir of the Grateful Dead just passed away over the weekend. And the title of my piece this Monday was 2026, What a Long Strange Trip It Has Already Been, which is a line from an old Grateful Dead song. But if you take a step away from kind of the day-to-day noise, if you will, and think about the big picture, I think one of the first slides that you had up, if not the first one, was economic growth, right? And so we think across a couple of different pillars. Growth, kind of, it's the economy, stupid. Inflation, policy, and that's fiscal policy and monetary policy, are really important drivers of asset class returns. And then with a little bit shorter time horizon, kind of, weaving in and out of that 6 to 12 month outlook comes sentiment. You talked a little bit about sentiment and positioning overall. And maybe so to start with the economy and growth, you can break economic growth into a couple of different quadrants. Is it good? Is it bad? Is it getting better or getting worse? And so, is growth strong? Is growth weak? Is growth accelerating or decelerating? And based upon those 4 different quadrants, using history as a guide, it doesn't always repeat itself, but it does rhyme. It's kind of like counting cards. When economic growth is good and when it's accelerating, that is really good for stocks. You showed, earnings, when earnings are growing, that is good for the stock market overall. When things are bad and getting worse, that's kind of when you want to move away from risk overall. And when things are bad and they're starting to get better, that is oftentimes one of the most difficult environments to add to risk. There's a Sir John Templeton quote, and working for Franklin Templeton, there's Sir John quotes all over the office about buying when others are despondently selling. Is one of the greatest times to be investing. And so where we're sitting today, if you look across the globe at pretty much all the major regions, there is a dearth of bad and getting worse. Most everything is good, and it's kind of oscillating between good and getting better and good and moderating and maybe slowing down a little bit. And that backdrop for stocks is really, really positive. From an inflation standpoint, the numbers you just mentioned, 2.7% on headline CPI. That means that prices are rising, but they're rising at a slower pace than they've been rising in the past few years. And so overall, that is getting good or getting better. Prices are, and that's kind of on an aggregate basis. In some areas like food, one of the more headline grabbing areas, it's a little bit more problematic, but overall, inflation is becoming more manageable, I'll call it. At the same time, wages are improving at a faster pace than prices are rising. So overall, again, this is not indicative of every single person in the US or global economy, but overall, in aggregate, wages are rising faster than prices, which is a good thing. Again, a positive for the stock market. And policy, you hear all the time about the Federal Reserve and lowering interest rates. And the path of least resistance for 2026 is for a modest amount of easing by the US Federal Reserve, our central bank, which means lower short-term interest rates, which is more stimulative for the economy. So the growth, the inflation, the policy backdrop, and this is globally, is very, very good. Now, if you take a look at a little bit more of the shorter term sentiment, a lot of the sentiment indicators that we look at, and they're less like 5-year sentiment indicators, which I think you had shown. They're a little bit more like 3 to 6 month outlooks on things. We're seeing some frothiness. We're seeing more optimism there. Not necessarily euphoria, but when people are happy about things and people are buying more stocks, there are fewer additional people to be doing so. From a positioning standpoint, most cohorts of investors have more assets in stocks than they do on average. And so it's kind of one of those analogies where when everybody is in the pool, today most people, I would say, are in the pool, the water level is kind of rising, and it's not necessarily overflowing today, but sentiment and positioning, so the setup is bringing our level of conviction down a little bit. And so the term that we tend to use within our group is responsibly bullish. whereby we're taking on more risk than on average relative to our benchmarks, relative to historical norms, but we're doing so responsibly and not getting too far out over our skis and buying everything willy-nilly. We do also think that there is a big rotation going on. To your point, the rest of the world is starting to catch up with the US, and there are tremendous opportunities to invest outside the US today. And even within the United States, the sector rotations and the style rotations is helping to lift all boats, if you will. And technology stocks are no longer the only game in town. And that is excellent for markets, and that is healthy for markets.
Totally agree with that. Okay, Phil. Cliffwater is in a very, very unique situation. You have the standard index for private credit. So you have like the S&P Golden Index that was created at your company, correct?
Right. Correct. Yeah.
Does that have it has a special name, right?
Yeah. The CDLI, which stands for Cliffwater Direct Lending Index.
And it's a very diversified index.
That's correct. Yeah. Tens of thousands of underlying loans.
And you manage money to that index.
Sort of. Yeah. We have the index we created in 2015, really because we were doing it in our institutional business. We were doing a lot of work in the asset class. We were very early there in terms of our conviction in it being something that a lot of investors should own as part of a diversified portfolio. And what we found was, as we got to know a lot of the managers in the space, we found who we liked. At the time, there didn't exist a good data set in which we could benchmark them to whether they're doing a good job or a poor job. And so our founder, Steve Nesbitt, said, well, if it doesn't exist, I'm going to go build it. And so he built this index that gained popularity throughout the industry. A lot of managers began using it in their own marketing collateral and fund documents, et cetera. And so it really became, in my view, like the S&P 500 of private credit. And I think served a useful role in helping investors and allocators and advisors better understand the asset class's attributes over a very long period of time. The index, while it was created in 2015, has data going back all the way to 2004, so predating the financial crisis. So we now have an over 20-year period to understand how this asset class has performed in bull markets, bear markets, periods when stocks are doing well and poorly, when bonds are doing well and poorly. And what we found is that it's proven to be a very consistent, stable, and resilient asset class and providing a very valuable third leg of the stool for a diversified portfolio, largely due to the high yields that it offers. It's very much an income-oriented asset class. And relative to core traditional bonds, which are fixed rate and more sensitive to interest rate fluctuations, direct lending or private debt, the terms are somewhat interchangeable, is floating rate. So in a year like 2022, when rates shot up in short order from 0 to 5%, I think everyone in this room probably remembers what their portfolios looked like in that year. Stocks down 20+%. And bonds down double digits as well, which is something that no one was very used to. Worst year for bonds on record. Our index was up over 6%. And so I think it's really become a very attractive alternative for a lot of investors. And so really, to answer your question, Marianne, the index is kind of what inspired our first fund launch, which was in 2019, which is the Cliffwater Corporate Lending Fund, which is structured as an interval fund. And while it's not technically an index fund, because it's not like the stock market where you can quickly create a fund that tracks the index. These are private loans. They don't trade on a secondary market, but we found a lot of power in our background as a consultant. It means that we have a lot of these lender relationships. And so the way we built our fund was, hey, let's work with 30 or so of what we view as the top lenders in the private debt market. And by having that volume of lenders we can allocate capital to, you end up with a very index-like portfolio that consists of thousands of loans, very small position sizes. And that's our sort of view on the asset class in general, is that in credit, in equities, if you take outsized bets, if you get it right, you can be rewarded with a lot of upside. There's no upside in credit. Your yield is your upside. Your net return can be taken down by one of two things. It's credit losses and fees and expenses. And our view is, well, let's create a product with low leverage, low fees, and no single borrower, no single credit if it goes bad, because it is credit still. That's the reason you capture those premium yields over time, is you're bearing credit risk. Well, we don't want any single borrower running into an issue having an outsized impact on the returns of our portfolio. And so that's the approach that we've taken there, is that we don't feel we're rewarded for taking big bets. And so we want to, really capture the broad market beta of the asset class, as opposed to trying to seek alpha or outperformance.
Now, not everybody here might understand what an interval fund is. Can you explain an interval fund? And I think it's important, especially in the private markets, to understand with some of these products, what's the liquidity like? How often can you get access to your liquidity?
Yeah, a good way to start would just be to compare it to the traditional way that investors have historically accessed things like private credit or private equity, which is through limited partnership structures, otherwise called drawdown funds, where you'll commit to a fund, a certain dollar amount, and that they're not taking all of your money at once. They will call that capital from you over a period of multiple years. And then in the subsequent 3 to 5 years after, if they exit their companies or the loans mature, if it's credit, that capital gets returned back to you. But it's a very illiquid structure. You should be comfortable, sacrificing your money and not expecting to have access to it for potentially a decade or longer. Which for certain investors, that's not an issue, but most folks prefer to have some flexibility around liquidity, and it can help them with ongoing, rebalancing of their portfolio, or if something unexpected pops up, they can potentially, tap that. And same on the purchase side too. You're not waiting for the next fundraising cycle to come around. These are called evergreen vehicles, meaning they're always sort of open for business. So investors can come into daily an interval fund, and they can exit either on a quarterly basis, in the case of our 2 credit funds, or our private equity fund has semi-annual or twice a year ability to redeem. And so these evergreen funds have grown a lot in popularity because they solve for a lot of the pain points and operational hurdles that historically limited partnerships or drawdown funds have had, which is very high minimums. You annoy your CPA because they get a K1. You don't have a lot of liquidity. What we do in interval funds is provide that semi-liquidity a handful of times a year. The investment minimums are very low, broader access to different investors of different sizes, and more flexibility on when you can come in and when you can come out. And so these types of structures have really grown in popularity over the past decade or so. At Cliffwater, we've become the largest manager of such interval funds in the market, with about $45 billion across our 3 funds today.
And one of the things I want to mention is I have done podcasts. I do podcasts every month. I've done a podcast with people from Franklin Templeton and from Cliffwater, and you can learn more from those podcasts, by the way. And they're on all the podcast channels, including YouTube. Tom, I'm going to ask you the elephant in the room questions. Not questions. So we opened up the year, and I think it was January 3rd, we had a military action in Venezuela. We want to take over Greenland. And we've threatened to go into Iran, although it seems that things have died down and Trump has dialed back off of that. When you get that phone call from your client, like, Tom, what do we do because the geopolitical environment looks nutty? And that's a polite way of saying it. Yeah. How should a client react in this kind of environment?
Yeah. Thanks for the really easy question.
You're welcome.
Answer.
Well, that's why you showed up, right?
Yeah. So geopolitics are really, really difficult to model, to predict, and to kind of handicap ultimately what is going to come out of them, right? If you look at the economic cycle, there is a pretty nice, steady, cyclical nature to the economy. That's not necessarily the case when it comes to the whims of leaders of governments, regardless of who and where and when. And so we look at geopolitics, we think about geopolitics, and we do our best not to react to geopolitics because it is so difficult to handicap what's going to happen and what the outcome is going to be. Generally, when we are in an environment where geopolitical tensions are higher than normal, that just means there's a lot more uncertainty as to ultimately what is going to come out of that. And when things are uncertain, there's more perceived risk. And generally, all else being equal, that's an environment where you might want to not take a lot of active risk and try to predict something that might necessarily happen, and kind of stick to your knitting, stick to your portfolios, not necessarily ignore things, but and this is very much the case. We can kind of call the tariff stuff geopolitical, if you will, from last year, but we saw one of the fastest drawdowns, so stocks falling by over 10%, in a very short period of time ever. And then we subsequently saw a recovery that was the fastest ever. And if you panicked and sold at the bottom, you were going to miss that recovery, right? And so there's this notion of time in the market over timing the market. And so to that end, while it's very difficult to do so, we do try to discount and not pay too much attention to geopolitics when making investment decisions.
But this is where diversification helps a
Correct.
portfolio,
Yes,
right?
absolutely.
And the more risk averse you are, the more defensive you would be in terms of your positioning.
Yeah. And there are certain assets that do well in periods of heightened geopolitical tensions.
Gee,
You have
gold's
Right.
done phenomenally well.
Yeah, and there are three kind of major themes that we would say are driving gold right now. One is geopolitics. Two are concerns about fiscal deficits. And three, we would say that there is kind of going along with that and de-dollarization and concerns about the US fiscal deficit and the fact that we're not being nice to the rest of the world oftentimes. There's central banks around the globe that are moving into gold as an asset, as a store of value. And under the assumption that those three aren't going to go away tomorrow, that will likely keep gold prices higher for the foreseeable future. And that's another point of diversification.
And we have gold in our models.
Correct. Yeah.
You never have enough, though. When things go a little awry, I will tell you, then you never have enough. Phil, last year, there were some concerns in the credit markets that popped up. And Jamie Dimon, the CEO of JP Morgan, used the word cockroach. That, once you see one cockroach, there's many cockroaches, meaning that the risk is we might see more defaults or issues in the credit market. I think this needs a little bit of clarification because one of the big defaults that happened was not due to credit risk. It was due to more fraud. But what can you explain what this hiccup was? Because if you notice, we're not talking about it anymore. But what was that hiccup that spooked investors in the credit markets last year?
Sure. So there were a handful of high-profile bankruptcies. Yeah, most notably, I would say probably First Brands and Tricolor were the two names that got the most attention. There was a handful of others. When Jamie Dimon speaks, a lot of people listen. And when you have a soundbite about cockroaches, naturally the media latches onto that and kind of runs with it. Where we operate and where private credit as an asset class operates is a very different lending model than bank lending. In fact, the reason it's grown to the degree that it has today, estimates about $3 trillion in size of private debt as a whole, is much larger than it was 20 years ago. And the big reason why it matured and became so established like it is today is because of post-GFC regulatory constraints on banks. A lot of the lending activities that banks used to do, they were no longer able to do to that same degree post-GFC. And so really direct lenders stepped in to fill that void and provide financing to middle market companies across the United States and other parts of the world, et cetera, which is very much needed. The model is quite different. When banks originate loans, they originate to syndicate. They're not originating these loans to hold on their balance sheet. They originate to then, to different pools of other investors that will buy them, be they mutual funds or CLOs or other institutional investors. And so direct lenders, by contrast, originate to own. They hold the risk until maturity. And so they're more incentivized to have stronger underwriting, tighter covenants, et cetera. It's just it's a better matching of assets and liabilities. These are loans that are held in funds that are not available at a moment's notice like bank deposits are, where you have a much bigger asset liability mismatch. And so we think over time it's proven to be a better lending model. And both borrowers and lenders and investors alike are reaching that conclusion. The challenge is when there are headline defaults like there were last year, everyone starts to paint credit in general with a very broad brush. And if you actually do your homework and look, these were not direct lending loans that went bad. These were primarily bank-led loans. And yet somehow the media really kind of ran with this narrative that, oh man, there's trouble brewing in private credit. There must be cracks on the horizon or more cockroaches, when in all actuality, this was mostly poor underwriting done mostly by banks. And really, unfortunately, direct lending kind of took it on the chin because of that, not in returns, but in terms of sentiment around the asset class. We tried to do our part to help further educate folks on what exactly is going on here. If you look at those two, a handful of other, like the big five headline bankruptcies, only one was an actual direct lending deal. Only two of the five were to private equity sponsor-backed companies, which is almost all of the lending that we do is to companies backed by private equity sponsors. That ecosystem is in much better health, much better shape. And when we look inside of our own portfolio, our what they call non-accrual rate, which is a measure of loans that are not currently paying cash interest, which is a potential sign of loans that might, default, sub 1%. And so and if we look at the like real time kind of earnings and revenue of our underlying portfolio companies that we have loans to, it's double-digit year-over-year earnings growth and revenue growth. And so we see very solid portfolio health, much different than the noisy narratives that are kind of out there today. But I think it's been an environment that's impacted sentiment to a degree, which may be a good thing, because if you think of like how these loans get priced, it's sort of a supply and demand thing in terms of the credit spreads. And so if it does maybe slow down the inflows to the space, while at the same time, if we start to see a lot of this accelerating economy leading to more deal making, more M&A activity, et cetera, when you have the same pool of lenders fighting over more loans instead of fewer, that should ultimately lead to more normalization of spreads, better returns for investors. And so again, it was a very great soundbite by Mr. Diamond, but it was not related really to what we're doing in this asset class.
I think what's also important to understand is that there's always losses. I mean,
Yeah, exactly. Yeah.
it's another thing. We have an unusual amount of no losses,
Well, and
but it's normal to have a certain percentage of losses.
For context, and this is important because we have the index data, which spans 20 plus years now, is over that 20-year period, the average default rate has been 2% of loans defaulting. And typically those have had an average of a roughly 50% recovery rate, which means credit losses of about 1% annualized. Not all years, some years have lower, some years have higher, but that's been the historical experience. So even in really, really good years for the economy, for stock markets, there's going to be companies that run into issues. That's just the nature of the asset class. We think it's an asset class that you can properly manage the risk around that. And those type of events, it doesn't mean you're not going to occasionally deal with them, but if you can, keep those positions small and work with high quality lenders, we think you'll be more than compensated in high current income over time.
And generally, the risks really rise in a recession, not when an economy is growing 3 to 5%. Right? Okay, Tom, I'm going to give you another difficult question. Well, you're so good at this. That's why. Tom's really good. We work a lot together. Can you explain the crypto market from a Franklin Templeton perspective? I'm going to leave that wide open. You can go anywhere you want. You can just talk about Bitcoin. All right. Can I tell them a story first?
Yes.
Okay.
Yes.
While you think about your answer. How many people have seen Star Trek? Right? Everybody's seen Star Trek.
First to say I haven't.
You've never seen Star Trek? You're joking. This could become a comedy show. Okay. Do you remember Kirk and the flip phone? That seems like ancient technology, right? Think about Star Trek: The Next Generation. The consoles are all iPads. Do you remember Data? Data's a human robot, right? They had drones. Do you remember the hologram? If you want to go on vacation, you went in the hologram. That's virtual reality. That's what Meta is working on. And that you can go into virtual offices now. My point is, if you follow Star Trek and you follow the technology in Star Trek, what used to be our fantasy has become our reality. Now, here's the tough question. What was the currency on Star Trek? What? Yes, there was. Do you have your phone? Google it. There was currency. There were two pieces of transaction. Latinum, which had to be, you're correct. Most people don't know this. And it had to go in gold because it was not a stable metal. So gold was still a medium of exchange. There was one other form of currency. Do you remember what it is? Federation credits. You can Google it. It's out there. So it was a credit. What's Bitcoin, Tom? It's a credit on the blockchain. I'm just saying.
You answered the question for you.
Can I take the physical challenge, please?
Yes. Go ahead, explain. I tried to help you out.
This is one area that I'm not very good in.
I
I
can't
have to
believe that.
admit.
I can't believe that.
So-
But what does your asset allocation people say? You
Yeah.
go in terms of the smart people with the models and they're doing all this data analysis. What are they saying about crypto?
So yeah, so from a portfolio standpoint, crypto has very few properties that overlap with your traditional equities and your fixed income. It is a decentralized finance type of an asset, whereby its risk and return properties are not very highly correlated to other markets, i.e. they don't move in the same direction and to the same magnitude at the same time. Therefore, from a portfolio standpoint, the more you have things that look and feel and smell and behave different in your portfolio, the better the diversification that you have, and the more stable the returns that you have over time. And so when thinking about the utilization of digital currencies like Bitcoin or Ethereum, for example, Bitcoin is the largest, we would tend to invest somewhere in the vicinity of 2 to 3% in a moderate level of risk type of a portfolio in order to obtain better diversification, which lowers your risk, without sacrificing return in portfolios and kind of helping to stabilize the ride there. For more conservative portfolios, it's kind of a 1 to 2% allocation. And for portfolios that can withstand a little bit more risk, somewhere in kind of the 3 to 5% range is where we would recommending putting allocations to Bitcoin and cryptocurrencies.
So we've reached the program time where we want your questions. What do you want to know that maybe what we talked about or didn't talk about? I can take that if you don't. No, I have a mic. Okay. So stable coins is a fancy term for $1 US that's digital, that is backed by short-term US treasuries. You don't earn anything on it. You don't make any money on it, but you can transact. And the transactions that we're seeing are quite significant. Last year, we saw transactions that were higher than the transactions that we saw on Visa and MasterCard. Now, yes, extraordinarily very high transactions, but most of those are businesses because do you know anybody who takes stable coins? If you go shopping, you know anybody takes Bitcoin? We're not quite there yet. It's mostly like institutional or small business to small business that are doing transactions, or individuals outside the United States. So the adoption of crypto has been very, very high in emerging markets. So think of a country like Venezuela that has very high inflation, or any country that has high inflation. They've gone to the crypto market and they want to own US dollars and they can own stablecoin. So many individual investors, you have to even think even the poorest person may actually have access to a phone. And if you have access to the phone, you have access to crypto. So that's another adoption that we're seeing is individuals outside of the United States that have extreme volatility in their own currency are opting to actually own US dollars through stablecoins. And, you know, if you have a little app, Coinbase, you can go up and buy stablecoin. It's very easy to, you know, buy and sell. And again, the adoption rate is expected to get higher for stablecoin. Did that answer your question? Okay.
I could just add to that a little bit. Like a lot of usage of stable coins are people that are investors that are very native to the crypto and digital asset like ecosystem. They're doing a lot of trading where they'll, you know, temporarily, if they're trading out of Bitcoin and into Ethereum or something like that,
They hold
it's a
it in
temporary holding place for it. In other words, they don't care that they're not earning the interest. If you're looking for a place to park your short-term money and earn a little bit of yield, that stable coins are not the place for you. You're still better off in a money market fund or, you know, short-term T-bills or something like that. It's more of a tool utilized a lot by crypto traders, also for moving money. If people are remitting money back to people in different countries, it can be a way to maybe convert from a cryptocurrency briefly into a US dollar, send that over, you know, to someone else. And so it's not, it would not something you would likely want to buy and hold. It's a fantastic business model for the stablecoin, you know, manufacturers, and that they get to keep all these are backed by short dollar assets. So they're earning all the income, but they're not paying any out to you. So wonderful business model, but for investors, not something you necessarily need to think about owning. Yeah.
Other questions?
Share that we're monitoring the online chat. So if anybody watching online has a question, just put it in the chat and we'll bring it to their attention.
Thank you. I forgot to mention that, sorry. Any other questions? Oh, somebody's sitting there that wants to ask a question, I know.
The news feeds tend to highlight China a lot. China's what?
It's an important economy.
Innovations. They do have a rather important economy, but we get information on the fusion, for energy fusion, and the robotics with China. And we hear very little bit of that about the United States, and it always seems to be we're second best in those areas. Do you see this as a
Oh,
problem?
definitely the United States is behind in robotics. I don't know about fusion. You got anything on fusion? But China is more advanced. Now, China did develop an AI open platform called DeepSeek. And there was concern that the United States was behind China. That concern has been lifted. But what it did do is open up to the world that China's developing technology very rapidly.
Yeah.
They are a competitor in technology.
Very good.
Which in some cases competition is a good thing, right? And maybe with China, it's more co-opetition. You know, we're certainly competing with them in a number of areas, whether it's robotics, but technology is one where the U.S. has been dominant. And having somebody constantly nipping at our heels helps to keep us on our toes and continue to, you know, to innovate.
60 Minutes recent episodes highlighted that schools
Jeez.
are really coming ahead in the Chinese arena, that are taking this technology to the students, young people, and we tend to be having problems with our schools. What's going on here?
I don't know. I don't know about schools, but I know they have flying cars. They do have flying cars. No, I mean, China has a lot of smart people. And they're developing technology. The question you want to ask is, what global corporation wants to adopt Chinese technology versus US technology? That's where they don't have a competitive advantage. They're not trusted.
You had mentioned that Japan is your favorite market. Do you have a favorite stock or ETF within Japan?
I have a lot of favorite stocks, but I don't do stock picking in Japan because I'm just not an expert in Japan. There are ETFs that are out there. WisdomTree is probably the company WisdomTree is the most well known for having an ETF for Japan. And then the question is, and this, they probably have other hedged ETFs that I'm not aware of in the global markets. But WisdomTree has a hedged or non-hedged ETF for Japan, meaning they hedge the currency. And the purpose for that is if the currency depreciates, you're losing. And do you want to hedge that? So that's the determination. But look at WisdomTree for ETFs.
So I think the currency hedged Japanese equity ETF from WisdomTree that you're referring to as DXJ? Yeah.
Yes,
And so,
DXJ.
so that will get you exposure to Japanese stocks without the currency fluctuations between the dollar and the yen, right? The dollar has been quite strong for the last X number of years. 2025 was a bit of an exception. And when the dollar is weaker, as US-based investors, when the dollar becomes weaker relative to foreign currencies, when you sell those assets and bring them back into dollars, you're getting more dollars back for your foreign currencies. And so if you are of the belief that your home currency is going to depreciate, then you would want the currency exposure, i.e. unhedged exposure from non-US stocks. If you are concerned with or just looking to get the access to those markets, then currency hedged would kind of be the place to be.
But I'll let you in on a little secret. Over time, currencies are a zero-sum game over 10-year time horizon. In other words, over 10 years, currencies will fluctuate, but after 10 years, they wind up right back where they started.
Yeah.
Generally, mathematically, they do.
And kind of our base case when investing in stocks globally is not to hedge the currency exposure because of that phenomena. There might be times when we would want to do so. However, in fixed income, where currency fluctuations can overwhelm the interest rate fluctuations, and under the auspices of accessing fixed income exposure, bond exposure, and not having currencies be the dominant force in your returns, most of your non-US fixed income exposure is on a hedged basis as a general default.
Any other questions? In the back? Okay. The mic is coming.
Thank you. You mentioned that geopolitical concerns or volatility don't tend to have too much of an impact on the market generally. Would you categorize the potential perception of the Federal Reserve reacting or responding to political pressures in that same category as non-volatile geopolitical activity? Or would you say that that is kind of its own category that could have a bigger impact than just the standard kind of chaos that we're seeing?
I don't think this is one you ignore.
Yeah. And there are concerns over potential influence over the Federal Reserve.
That would be different
If that's.
if that actually did happen.
Yeah.
If this, what's going on right now is not a big deal, but if the government became the Fed, the bond market for sure would not like that.
Yeah. And the bond market in some ways is the ultimate arbiter of these things. And if the bond market doesn't like that, prices go lower because of perceived increases in risk in government, US treasuries, US government debt. Therefore, yields go higher. Now, our administration wants yields to be dramatically lower. And so there's a certain amount of kind of game theory that goes on with that. Again, we try to discount some of these things. But if the bond market is going to take yields higher, which is diametrically opposed to the outcome that the administration would like to see happen, that would certainly give them cause for pause, all else being equal.
So I'll add to that. So why would Trump do this, especially when he's about to name the new Fed chair? We're within weeks of a new Fed chair. So why do all of this? Because Powell has the opportunity to stay on the board for 2 more years. And some people believe he is trying to not have him stay on the board for 2 years. Now, let me let you in on another little secret. Most Fed chairs don't stay. They leave and go back into the private markets because they can make a ton of money. Just even lecturing, they can make a ton of money. So to be honest, many of us on Wall Street are befuddled How's that?
Thank you.
That one befuddles us.
Geo befuddlement risk.
Geo. I normally can figure things out, but that one I can't. I don't get that. We can take one or two more questions. We answered all your questions, all your concerns, all your fears.
From the virtual.
Yeah, do we have anything from virtual land? All right, then I'll ask these guys one more question then. And I'm going to ask you each the same question. It's an easy question. This is easy. What haven't you talked about that you think is important for investors to know? Phil. Yeah, because there's a lot of things we didn't cover. So is there something that we didn't talk about that you think is important, or reiterate something that you think that you did talk about that you think is important?
I would just want to emphasize, obviously as a firm, we're huge believers in private markets and the potential benefits they can bring to a portfolio. But it comes with a trade-off. These are not liquid. You can't buy and sell private markets on a daily basis. So I think that's an important topic and an important consideration for everyone in the room to spend time with your advisor with, is thinking about what your budget for illiquidity may or may not look like. And that's something that's, as these types of solutions are becoming more accessible, it's really opening up a broader array of diversification opportunities for investors that don't necessarily need daily liquidity for their entire portfolio. And one thing I would mention too is private markets today have grown significantly. I mean, I think I mentioned earlier, private debt about $3 trillion, private equity markets as a whole, some, I don't know, 11, $12 trillion. These are massively larger parts of global wealth creation, global economic activity than they were 10 or 20 years ago. 20 years ago, it would have been a conscious, active decision to allocate to private markets. Today, increasingly, I think it's more of an active choice to not allocate to private markets. Private equity as a whole is larger than the emerging market stock market globally. It's larger than the US small cap publicly traded stock market. These are big pockets where increasingly companies are staying private longer. A lot of the companies that would have probably IPO'd 5-10 years ago are still private today, and then in some cases are worth, hundreds of billions of dollars already before even entering the private markets. And so I just think there are now a great breadth and depth of solutions out there of high quality that I think investors can utilize to build portfolios designed for more optimal outcomes. And so we just want to, I guess.
And what's the yield advantage
so
that you get for taking that additional liquidity?
In the case of direct lending, our index over 20 years has been about 9.5%. Our fund that's been live now for close to 7 years has been about 9.5% annualized. And that's been relative to equivalent public credit of similar credit quality, about a 4% return premium to that. And so that's compensation for bearing that illiquidity risk. And if that's a trade-off that your financial situation can allow for, we think it's one worth making. Again, it doesn't have to be your entire portfolio, but for a portion that you can allocate to something that we can really, I think, improve return outcomes over time.
And Tom, what haven't we talked about that you think is important for investors to know?
Maybe I'll just reiterate, diversification, including things like privates, staying in the markets and staying diversified. And there's a guy by the name of Albert Einstein who was fairly smart, and he once famously said that compound interest is one of the most powerful forces on earth, right? Staying in the market and letting time be your friend. There is another asset class or area within equities that we haven't really talked about. We mentioned non-US stocks and being global, and that's emerging markets, right? That is an area that we think have some very solid opportunities today. We have a paper that's probably coming out by the end of this week that talks about emerging markets, and there are 3 or 4 themes that we mentioned as being powerful forces within stocks that have the advantage in emerging markets today. That one being growth. Growth in emerging markets is better, and the outlook for growth is better than that of the rest of the world. You mentioned in your earlier remarks about analysts and analysts kind of catching up and revising their estimates of what companies are going to earn on a go-forward basis. In markets that have analyst estimates that are rising faster than others, historically tend to do better. And that's the case for emerging markets today. We talked about inflation and policy. There's a lot more flexibility on inflation and policy in emerging markets today on balance than developed markets. We talked a little bit about corporate governance in Japan and doing more shareholder-friendly things with managing companies. And we're starting to see corporate governance improve in emerging markets. And then finally, on the dollar, when the dollar is not strong, I'm not going to say necessarily weak, but when the dollar is not strong, that is a boon for emerging markets. And for the last year, the signals that we've been tracking on emerging market currencies relative to the dollar has been a tailwind. And so this is an area that we think has certainly been underinvested over the last several years and have some fairly solid opportunities looking out over the next couple of years.
I agree with you. And we're overweight emerging markets in our global portfolios.
Yeah.
And with that, I want to thank all of you for coming here tonight.
Thank you, Mary Ann and team. We will be having a test on all of this. So I do want to recognize our team and the team of advisors at this point. Larry and Bobby obviously is here to help with this. We have Connor, Jonathan. You guys stand up and introduce yourselves. Jonathan, Connor, Matt, and DJ. We have Joanna in Arkansas and Mary Ann and Rachel in North Carolina. I'm sure I'm forgetting somebody, but the rest of the team tonight, you know, the operations and Mark and Lori, April, Cheryl, Grant, Aaron, and Linda, thank you again. And thank all of y'all. I know it's getting a little late and I appreciate your patience, and let's do it again next year.